Hey, this is Matt from InvestiQuant. Today is Monday, December 21st, 2020. This morning we saw sizable down gaps below Friday's lows across the market. The S&P gapped down about 56 points, which is larger than the entire range traded on Friday's options expiration day. So on Friday, we had about 41 points of range. This morning, we had a gap down of 56 points. So very sizable down gaps. We had quite a bit of volatility this morning. We did test lower by quite a bit, and then buyers have stepped in, and it's been a very tight grind higher, covering a lot of ground the rest of the session. So we're now up to about 65 points in the S&P. We have done so on strong volume. But what I wanted to do this afternoon is take a look at what has happened historically when you get this sizable down gap like we're having, and then you are trading in the top portion of the range as you approach the close in a similar environment. So let me go ahead and set this up and discover using all four instruments. We're going to use an intraday time-based setup for this, and for this one, I'm going to use an entry of 2:30 p.m. Eastern Time. It'll be set up as a long. The exit will be at the close of regular trading hours, which is 4:15 p.m. Eastern Time. Now, to define this gap that we had this morning, which was quite sizable, I'm going to say that we gapped down and that the gap size was at least 100% of the 5-day ATR. So we were at 150% this morning for the gap. Next, I'm going to go into the indicators section. I'm going to put us in a similar market environment, which is above a 10-day simple moving average and above a 200-day simple moving average. And then the last thing I want to do is I want to come into this post-open filters section, and I'm going to say that we are trading in the top half of the intraday range as of 2:30 p.m. Eastern Time. So to do that, I go to this intraday close versus intraday range, and I click equals next to close and top half of intraday range. That will define the pattern that we're looking at, where we're trading in the top portion of the range after this sizable down gap in a bull market. Now I can click view results. And here we go. So these are the results of going long at 2:30 p.m. Eastern Time, exiting at the close, which is 4:15 p.m. Eastern Time, when you get the sizable down gap, which I'm defining as at least 100% of the average true range over the past 5 days. And you are trading in the top half of the range at 2:30 p.m. Eastern Time. This has taken place in a bullish market environment, which I've defined as above a 10 and above a 200-day simple moving average. Historically, this is very rare. So when you get these giant down gaps in a bull market like that, it just does not happen very often. And then when you add a little bit more context around where you're trading at in the session, you can see how few samples we have here. Just 17 samples dating back to 2003. So that's roughly one time per year that this has happened for the S&P. That is also true for the NASDAQ and the Dow. All of those 17 samples. The Russell, only 5 instances where this has happened. So very rare pattern here. If we look at the win rates on them, the S&P coming in at 71%. So just a few more have closed above that 2:30 p.m. price than below it. The NASDAQ and the Dow, both very similar there at 53%. So really no discernible edge in either of those two. And then the Russell really has too few of samples to think much about it at 80%. So 4 out of 5 of those have closed above that 2:30 p.m. price. But again, we're looking at 5 samples. And as a group, very light sample sizes with this pattern here. If we take a look at the average win, average loss, they look pretty similar, especially when you consider that we have very few samples. So with smaller samples, it doesn't take much to really move those numbers apart from each other. But they're fairly similar in size for the S&P, for the NASDAQ, for the Dow. They're all similar in size. And like we said with the Russell, this just does not happen very often in the Russell. And the average win is a little bit bigger there than the average loss on those 5 samples. But historically, this is a very rare pattern. It has not been weak. I'm not going to say that it's a strong pattern either, though, just because we don't have enough samples to get too excited about here on these numbers. So hopefully you found that helpful. Good luck today, and we will see you next time.